Today we want to talk a little bit about retirement income diversification and why it's important. Everyone seems to understand the concept, the basic concept of diversification. Don't put all your eggs in one basket. But most people apply this solely to their portfolio. Look, I've got stocks, I've got bonds, I've got real estate. I'm diversified, right? Well, yeah, at one level, but this unfortunately isn't enough, especially when it comes to the retirement phase. You need to diversify the retirement income as well as the portfolio holdings. You see, stocks, bonds, and real estate generate different types of income. But if they've been diversified to create growth, which is important, they're not necessarily diversified the proper way to generate income when it gets to that phase. The allocation strategy for one phase of life is different than the allocation phase for another. Retirement income diversification, essentially, is properly diversifying, identifying, first of all, and managing multiple forms of income rather than just focusing on one specific type. The strategy allows you to protect against the risks of market downturns, inflations, outliving your savings. Diversifying the income offers the flexibility, the tax advantages, and stability that you need during financial challenges specifically, but in general over this long period of time that represents retirement. The various sources of retirement income, important to understand, as well as the risks that they face. So if we quickly kind of go down the sources, and we'll get into these in a little bit greater detail, but you've got guaranteed income, there's variable income products, there's investment portfolio income. Three basic categories of where retirement income is going to come from. The primary risks come from longevity, market volatility, inflation, cognitive decline, and then emergencies. So what we can do, and what you're going to see now, is we can compare how each of these different sources handles the various risks. Guaranteed income, variable income products, investment portfolio, relative to longevity, market volatility, inflation, cognitive decline, and emergencies. Some of them offer very high protection in several categories, and unfortunately low protection in other categories. And then others, vice versa. Variable income products tend to be right about in the middle in that they offer moderate protection in all the different areas, but they never really rise to the level of high protection in any one of them. So this table essentially illustrates that no one income source is going to cover all the risks. What we want to do is not just go to one extreme or the other, but to mix these in a way which is going to fit your situation. Now, the main providers of guaranteed income, let's take a look at those. Social Security is usually the one that everyone refers to. It is, in fact, the cornerstone of most retirement plans. Full retirement benefits usually start at 66 or 67, depending upon when you were born. But you can, if you want, start a little bit early. The actual benefit's going to be based on the 35 highest earning years, not quarters, not months, but the highest 35 years. And it is influenced by when you start. So you can go as early as 62, but you can also delay to 70. That gives you the largest benefit. Roughly, you're going to get an 8% increase in your monthly benefit for each year that you wait until age 70. It also, Social Security also adjusts for inflation. It does have a formula, cost of living increase, so it's going to go up. The other common, or maybe not as common as it used to be, but the other common one we find is traditional pensions. About 20% of workers today have access to one. They provide typically a fixed monthly payment based on your salary history, your years of service. There are sometimes payment options. You can take your pension payment over one life, take it over 2 lives if you want to include your spouse. Sometimes you get different percentages. I want 100% of some benefit for the longer of our lives, or you can say I want 100% of my benefit, but if something happens, I'll let the spouse go to 50%. So you get different combinations. You also know you have things which are called life certain. You can say, I want to know that it's there for 20 years, and then you can get combinations of that. So there ends up being usually a pretty broad and extensive and complicated grid of what pension payment you can choose. And it's important, obviously, to choose the one that fits for you. And then once you do, it's going to become a fixed income source in retirement. Fixed annuities, as their name implies, also offer this. They are insurance products that are designed to pay a fixed monthly benefit. There are 2 types of these, either an immediate annuity versus a deferred annuity. Immediate means you put the money in right away, you start taking the benefits. Deferred means you're going to put money into the annuity either over several years or in different phases, once now, 5 years, and then 10 years, whatever. You're putting money in over a deferred period of time, and then you start the annuity payments when you need them. They usually come with very heavy embedded costs. So you're not going to get the performance that you would elsewhere, but you do get the fixed nature of the income stream. So there's a sense of confidence or protection there. Usually, once you annuitize, which means you start that income stream, that payment stream, the principal is no longer available. It has now been converted from principal to it's a payment stream, and it's going to last as long as the formula that you picked. The payments usually cannot be changed easily, if at all. The main providers of variable income are variable annuities, on the one hand, very similar to the fixed annuity that I mentioned, except for the fact that you get to control, by virtue of picking investment options, what the contribution is going to grow to. So unlike the fixed annuity, where you either contribute right away or contribute over a period of time, and the insurance company controls how that money is going to be invested. This one, you are contributing money and the insurance company gives you investment options. So the ultimate principal balance that will then determine the annuity payment is, in a sense, the result of what investments you choose. You can do well, you cannot do well. There's some risk in those selections, but you can also do better than in a fixed product. But once again, once you then decide to annuitize, whatever that balance has become, you have all the same issues. The benefit formula is going to be presented to you, the years certain, 1 life, 2 life combinations. Once you annuitize, the principal balance is no longer available, and that payment stream is going to be very, very difficult to change. The other variable income product, is what's known as a deferred compensation plan. In many ways, it acts kind of like a variable annuity, usually sponsored by your employer, where they're saying to you, if you want, you can defer parts of your compensation from this year to another year. The reason that you would do that is you're in a higher income tax bracket now than you will be in later years. So you're making the choice of saying, look, I don't want to take $200,000 now. This year I don't need it. I'll take 100 and then delay another 100. And if you do this over a couple of years, you're building up quite a balance. Many times you get some investment options, so this balance is going into a fund that you can then grow. You basically establish this little nest egg that you're going to tap into. Once you decide to tap into that, the benefits start. The payment periods are much more limited than you find in other places, usually 2, 5 years, or 10 years. I mean, you can pick to get your income back out in 5 years from when you annuitize, or you can get it over 10 years. Once they start, again, they can't be changed. They will not increase with inflation. And unlike others, these are subject to the financial strength of the employer. The deferred compensation plan is what's called a general liability of the company. If you're with a strong company, no big deal. If you end up being with a weak company and they get into financial trouble, God forbid they have to go into bankruptcy, but then that obligation that they have to you rides right along with the other obligations that they have to their bondholders, their vendors, etc. They also come with some heavily embedded costs. Investment portfolio income sources, that third category, usually come from, your investment portfolio, whether that's based on a retirement account like an IRA or a 401k or a regular taxable account, as they call it. These are going to generate income from interests, dividends, and capital appreciation. All of these are part of what we call total return. Your balance is going to grow based on the interaction, the sum total of the interest, the dividends, and the capital appreciation that you receive over time. It's going to change based on interest rates, dividend policies, growth in the stock funds that you pick. It offers, though, the greatest opportunity for potential growth. Now, there are several different types of income streams or cash flow that can come from investment income. You can pick what's known as a systematic withdrawal. Basically say, look, I want to arrange for a monthly payment of, a quarterly payment of, or whatever schedule fits your lifestyle. And you're going to receive that so long as, obviously, the portfolio holds together. The other way to do it is to basically use what are called bond or CD ladders, where you're going to specifically carve out a portion of the investment portfolio and invest it in CDs and bonds with different maturity dates, maybe some of them at 3 months, and some of them at 9 months, then a year, then 2 years. The concept being that when they mature, they are matching when you need to have income, and since they're relatively stable, you know this part of the portfolio is going to meet your income, your cash flow needs for these years. Other way to do this is to just basically rely on the dividends from the stock and the equity funds. They typically will generate quarterly dividends, which during the growth phase, you usually reinvest in the investment. Get to retirement, you can say, I want these to pay out in cash. So now your cash flow is going to be determined by interest and dividends specifically as they are paid from the funds. Another way to look at this or to generate this would be to use Treasury inflation protected securities, where this is specifically, it's a bond that's going to increase in value and pay out with inflation. So you might buy a $100,000 Treasury protected bond and it ends up paying out 103%, I'm sorry, 103,000 at 3%, or it pays out 106,000 at 6%. In other words, at maturity, you know that the amount of money that you get is going to be protected for whatever amount of inflation there was over that period of time. Now, again, here's a quick breakdown of what these look like in terms of investment options, the primary source of where that income is coming from, the key benefits, and of course the risks. They all have some amount of risks, from over-concentration in payouts, cuts, interest rate risk, inflation erosion, lower yields, limited liquidity, market volatility, and just generally longevity risk of outliving whatever that portfolio is. So these need to be selected wisely. You need to put them together in a way that's going to meet your situation. And that's why this is so important, to essentially diversify the income stream. Now, I've thrown a lot out at you, but I wanted you to understand, here are the sources, here are the risks, and here's now how you're going to put them together. And I think the best way to illustrate that is with a specific case, client that we had. We've nicknamed them Eduardo and Maria just because we want to protect the names of our clients, obviously protect their privacy. But people have been very, very good. They have saved at very high levels during these working years. They've invested well for growth, stayed true to that investment allocation even during some of the very difficult times, and as a result, they've got a significant balance in their IRAs and their Roths and their regular accounts. Eduardo has also worked for a company which provides traditional pension and a deferred compensation program. Since Eduardo was going to retire early, he's got several options in terms of when to claim Social Security, when to start the pension, and when to trigger the deferred compensation payout. Now, they did go to online models before they came to us, which had recommended taking Social Security early, reducing the stock portion of the allocation based on their age and their stage of life. This is a very standard recommendation from the online models. Kind of fits the average of everybody, which means it fits the real needs of nobodies. In Eduardo's and Maria's situation, there were some very specific problems. The online models could not see their full picture. They could not see that Eduardo's pension had no inflation protection, and also couldn't see that the employer at this particular time of his early retirement was struggling financially, thus potentially jeopardizing the deferred compensation plan. We looked at the situation. The solution that we came up with was we decided we would trigger the deferred compensation immediately, and we would select the shortest payout period, 5 years instead of the 10. We recommended delaying the Social Security to increase the monthly benefit when the deferred compensation was set to expire. And then we increased the stock allocation during this phase to generate more growth for several more years, so that when they finally got to the point of relying more on the investment portfolio for income, there would be a larger balance there. The results, we drained the deferred compensation plan quickly to reduce the risk of the bankruptcy. We increased the lifetime Social Security payments by waiting until age 70 to trigger them. And we allowed the portfolio, as I mentioned, to continue to grow so that that nest egg would be larger and thus would afford larger cash withdrawals when they relied on it. So in this particular situation, the way we optimized it was to look at each stream's timing and the risks and try to eliminate the greatest risks first, defer the ones that were the safest until later, so that over the entire course of 20 to 30 years worth of retirement, there was a very high confidence level that Eduardo and Maria had that they were going to be able to retire successfully and not have that interrupted. So, general conclusion, there are risks. that you have to face. You need to identify them, whether they're market downturns, inflation, outliving your savings. You need to identify, figure out how you're going to compensate. You can't put your head in the sand. You need to properly diversify the portfolio for the phase of life that you're entering. It's not just what you were doing before you got to retirement. It needs to be the diversification allocation that meets your needs now in retirement. Identify the income streams, manage them appropriately, pick the ones in timing that you want so you're going to have that confidence. Now, it's complicated, so I don't recommend you do it on your own. We would love to help you, chat about your unique situation so we can develop for you the unique solutions that give you that confidence, just as Eduardo and Maria had. So give us a call, send us an email. We'd love to chat.